What's important for viewers to understand this morning, in your view?
Well, I think there are a few things. One is we still don't know how many people are truly infected with COVID-19. I guess the latest numbers from Johns Hopkins suggest almost 3,800. When we look at it, I believe that we're likely to find the true number is somewhere between 10 and 20,000 at this point. Seems like a reasonable number. And when I think about this kind of extrapolating out, the key point I'm focused on is where are the vulnerabilities in the healthcare system in the United States. And if we assume a doubling rate, which is basically a kind of fancy way of saying how many days does it take for the number of cases to double, of around 6 days, that means we could be at 434,000 cases within, say, 33 days if you're starting at 10,000, or at 27 days if you're starting with 20,000. The reason this is an important number is the U.S., based on our analysis, has about 21,700 intensive care unit beds available, or that could be called into service. If we typically find about 15% of people with COVID-19 need hospitalization, and 1 out of 3 of those people need an intensive care unit bed, at 434,000 units, we could be out of ICU bed capacity. So, importantly, by the way, the beds aren't special. What's important is that you have a ventilator because these are people in respiratory distress, and you also need healthcare experts who are trained to deal with these people. So that's the most important point we're looking at on the healthcare side right now.
Yeah, your language is striking in your note here, Ron, and I'll quote, while the Trump administration has either not grasped the severity of the situation or has not been honest about it to date, the Fed does appreciate the gravity of the disruption to the economy and markets. I guess on both fronts, White House response and now Fed, what's your grade?
Well, let's start with the Fed. I would give the Fed an A. I mean, I think the Fed recognized they did not have a lot of dry powder to work with. They also realized that if you don't have a lot to work with, you're better off trying to achieve a bit of a shock and awe to get most bang for your buck. And what they announced yesterday, I think, was a pretty sweeping attack on the problem, and they're doing all they can do. So I give the Fed an A, and we can dig into that if you'd like more. But the Fed can't solve a coronavirus, and that really requires the federal government to basically be at the front on the front foot. And what's disappointing to me so far is, frankly, even the bipartisan compromise legislation that passed the House on Friday night has giant loopholes. If one of the key intentions of the legislation was to make sure that people who are sick don't go to work and infect other people. But the legislation allows exemptions for any company with over 500 employees and allows for an application for hardship exemptions for any company with under 50 employees. Well, that's 80% of Americans work in those companies, which effectively means you're making people choose between putting food on the table or potentially spreading an infection. And if I look at the press conference on Friday at 3:30 from the White House, what was disappointing there is it quickly became apparent that the website for a national database that supposedly was being worked on by Google wasn't accurately portrayed. And also, it's great that these companies are offering capacity in their parking lots for testing, but it also still isn't clear who's going to be responsible to roll out that testing and when it will be available. So I think what we realize is the federal government has either been not aware of the situation or has been too focused on politics to make people aware. And this is really important. For people to understand the importance of social distancing, they have to be told the truth. And they have to understand these issues around ICU capacity and effectiveness. And I worry that we've had 2 months that have largely been wasted in terms of communicating that message.
Yeah, Ron, I mean, certainly there's a lot of different factors that are playing into all of this right now. And we know from Peter Navarro on our air earlier today that you're going to start to see some executive orders drafted around some of those things like medical supplies, for example, coming back to be manufactured here in the U.S. as well. So we're going to have to see how all of that continues to manifest. In the meantime, I want to get your thoughts on the market specifically. The fact that we're seeing, I guess I should say, the behavior that we're seeing manifest across different asset classes right now, the fact that you would have equities selling off, but also gold selling off here. I mean, the Treasury market specifically has been used as a gauge or a signifier for behavior or correlations across other assets. And we've seen that essentially break down in the past week as well. Do you feel like there has been, I guess, a disentanglement or that relationship has been compromised?
I think what you're seeing in markets is actually, it's a combination of factors. And I guess point number one would be, I think it would be unwise to try to trade this, because you can obviously get whipsawed and lose a lot of money. But I think what we saw last week in particular with Treasury selling off at the same time as equities was partly forced de-risking or basically deleveraging of some levered investors who were having to sell their liquid assets to try to meet collateral calls, and basically because in many cases risk models would force them to deleverage as volatility goes up. So to your point, historically you would be rebalancing from one asset class to the other. But in this case, volatility went up in all asset classes and forced people to lower their risk levels. So I do think that was hopefully not a long-term anomaly. But, I do think it's a great example. We've seen this in prior crises, by the way, or in prior sharp downturns, that we always have these mathematical models that tell us what correlations should be. And then whenever things are really bad, correlations go to 1. They don't end up being negative.
Yeah, and Ron, to your point about the Fed and just the federal government in general right now, how worrisome is the credit market picture? And what do you think needs to actually happen to keep credit markets open?
So I do worry that as we see these announcements rolling out, for example, last night from Illinois and Ohio, New York City's announcement in terms of basically shutting down bars and restaurants or avoiding congregations of over 50 people, I do think this is incredibly painful for the small businesses in the U.S. So basically, I think there's a critical need from Washington to figure out a way to, A, have a bulletproof sick leave policy, not what we passed on Friday, but something much more robust. B, to make sure that there are ways for companies to get access to liquidity, and maybe it might even end up being government grants or aid to keep people employed. Because, again, the most important thing right now is for people to engage in social distancing. If people are sick, they should stay away from work and make sure they don't infect other people. And we need to make sure that we keep that money flowing so people don't have to choose between paying the mortgage and going to work.
Yeah.
I think that's part one. But then part two on the credit markets, the Fed does still have more tools. There are limits on what the Fed can do, but I think what they announced last night is very powerful and should get money flowing back into these markets. I'm a little surprised mortgages aren't responding more positively, because I think the mortgage part of the announcement was very important. But keep in mind, the Fed had many programs in 08-09 that they used to try to make sure credit money got where it needed to go in the economy to keep credit markets open.